Alrighty, fire away.
Okay. Well, good afternoon, everybody. Thank you for joining us, and we're very excited to introduce our Atrium Lofts investment opportunity during the webinar. For those of you that don't know me, my name is Ivan Matthews. I'm the managing principal of Aliana Development. We also have Anthony Walker, CEO and managing broker of Buckingham Investments, and Malcolm Ziegler, investment real estate consultant for Buckingham Investments. Before we get started with this webinar, it's being recorded and will be posted to our investment portal. So if you have to leave early and or want to watch this later, it should be available early next week. Additionally, we'll be offering this investment as a 506B offering, which will be open to both accredited and sophisticated investors. And today's presentation is a summary of the investment, and further details will be provided in the PPM operating agreement and subscription agreement, also known as the offering documents, which will be provided on an investor portal for your review before deciding to invest in the deal. Please note the terms and explanations of our legal disclaimer regarding forward-looking statements. And we have an hour scheduled for this webinar and want to present the following information, along with taking time to make sure that we answer any questions you may have. Starting off, as I mentioned, part of the call, my name is Ivan Matthews. My company acquires Class B and C multifamily buildings at below market comparative prices and repositions and stabilizes them with a value add strategy of renovating units and increasing rents to provide risk-adjusted returns to our investors. Over the past couple of years, we've been focused on Long Beach and are now expanding into the coastal cities of Orange County and San Diego. And my background includes acquiring, developing, and financing close to $1 billion of townhome, condo, hotel, and mixed-use projects in several high barrier to entry markets. And my firm currently has 10 million assets under management. I spent a decade as an active duty Marine Corps officer and have continued to serve for another 13 years in the reserves. And I earned a BA from the University of Colorado and a master's in real estate development and finance from Georgetown University. At this point, I'll turn it over to Anthony to introduce himself.
Good afternoon, everyone. My name is Anthony Walker. If you don't know me already, I'm the managing broker of a local LA area multifamily real estate brokerage company. We've been around since the 1960s, obviously not myself, but carrying on the legacy here. I think my numbers are a little out of date here, but I've brokered over 300 million in transactions in the last few years, supervised company volume, I think getting close to $1 billion now. And I'm personally a very active investor in the Long Beach market, which is where this opportunity is located. I own about 15 buildings, about 150 units right in the immediate vicinity. And so this is my specialty. And I've also been a sponsor and principal in other syndicated deals in the same market over the last 10 years or so too. So bring a lot of experience right here in the local area. And I am also representing the group as our buyer broker on this transaction.
Thanks, Anthony. Our latest acquisition, Atrium Lofts, is a 21-unit 1940s Art Deco style building located in the Arts District of Long Beach's Commercial Business District. There's a picture of it behind me. It's a great building. We've actually been pursuing it for over a year and finally got it under contract last month. We're extending investors an opportunity to invest as Class A members, limited partners in LB7 MF LLC, a single purpose entity created to acquire the property. The building itself is 12,000 square feet, 2 stories with a great mix of studios, 1 bedrooms, and 2-bedroom apartments that are 20 to 25% below market rents. It currently has 3 vacant units with possibly a 4th by the time we close, which is a great thing because all units are going to require certain improvements to bring the units up to market rents, and we'll be able to turn those units and get those units to market rents relatively quickly after closing. Additionally, the underlying zoning of this building is a high density mixed use where potential owners can achieve an 80-foot height, and it lays in an opportunity zone, which may allow for additional exit strategies based on market valuations. Our value add strategy is going to include increasing the rents annually, taking a conservative approach to renovating units over 3 years and increasing rents to market. We realistically think that we're going to be able to achieve that in less than 3 years. We're going to leverage unique architecture and location to create a brand and sense of place for the building, i.e. Atrium Lofts, which we've already started renaming the building, and plan to exit at the end of year 3 with a repositioned and stabilized building. However, we're going to evaluate market conditions for the best exit strategy and to maximize investor returns. We're purchasing the property for $5.24 million with a purchase cap rate of 3.8%, which is a little lower than what I like to acquire buildings for. But since this is balanced out with several vacancies, which we'll be able to rent up quickly, and we believe we'll be able to exit at a 4.25% cap rate based on historical trends. We're seeking a total of almost $2.6 million in LP equity, of which we as the sponsors will invest 10% of the total equity. Atrium Lofts is centrally located in the East Village, also known as the Arts District submarket, in the central business district of downtown Long Beach. It's 1 block away from the 3rd Street neighborhood retail and restaurants, about 5 blocks to the beach, and is on major public transportation corridors. The city of Long Beach approved the downtown plan in 2012, which is outlined in red here. And the property is in the center of this red star, which allows for greater development densities and heights, encouraging economic development and business growth for this entire area of downtown Long Beach. It has continued to be a city in high demand for residents, even through COVID, demonstrating increasing rent growth and extremely high occupancy. We believe that this is a great real estate asset to own and invest due to its location, unique architectural style, great mix of unit types, building amenities for its downtown location, and underlying zoning potentially creating additional value. There's a lot to digest on this slide. I'm going to spend a few minutes walking through the numbers, metrics, and anticipated returns. If we start off at the top, and then I'm going to take you down through the left-hand side of the slide and then move over to the right to discuss anticipated returns. Our total capital stack for this opportunity is approximately $6.1 million with a purchase price of $5.4 million. With anticipated necessary working capital for deferred maintenance, renovation funds to bring each unit to market rent, and reserves, we anticipate that being about $345,000. Additional acquisition and closing costs and fees equal approximately another $345,000. Based on our current debt assumptions from our lender of receiving a loan of 65% loan to value, we'll be raising approximately $2.6 million in LP equity. And this will be finalized hopefully by the end of next week after the lender completes their underwriting. We'll be offering, there we go, this might be helpful. Our investors a 7% annual preferred return that is cumulative and compounding, which means that if the investment doesn't provide a 7% annual return by the end of each year, then the unpaid percent return accrues and compounds at 7%. So when the investment's cash flow is high enough, or during the refinance or sale, the investors will be caught up on the unpaid pref. Not every syndication or sponsor does that. After the 7% preferred return is paid and caught up, the remaining profits are going to be split in a 2-tier waterfall. From a 7 to 18% IRR, 70% of the remaining profits will go to the LP investors and 30% to the sponsor. Once the investor receives an 18% or greater return, then the remaining profits are going to be split 40% to the LP equity partners and 60% to the sponsor. We think this structure aligns with everyone's interests and incentivizes us, the sponsors, to provide a greater than market return before we begin to receive a larger proportion of the remaining profits. Additionally, our sponsor equity is going to be co-invested right alongside the other LP equity. We anticipate being able to provide an average 4.3% average annual return cash flow distributions, which are going to be provided quarterly. We also plan to conduct a cost segregation study upon closing to allow our investors to receive accelerated depreciation and potential tax loss in year 1. And we also believe in full transparency and have identified our equity investment and fees down at the lower left of the slide. We'll maintain at least 10% of the total equity that's invested. We plan to take an acquisition fee of 3% of the purchase price, a one-time administrative fee of approximately $90,000, and an annual asset management fee of about 1.5% of the total equity. Moving over to the anticipated returns. Those of you that know me know that I underwrite a lot of different scenarios, changing out assumptions, changing out exit years, to get a really good comprehensive picture of the what ifs and what can be's. Something I enjoy. Some people think I spent a little too much time on it and I'm a little too conservative, but I like to make sure that I really understand what I'm investing in and what I'm asking our investors to invest in. So for this opportunity, we plan to exit within 3 years. And so we have two different anticipated exit cap rates of 4.25 or 4.5%. We looked at two different rent growth strategies. One is a more moderate rent growth strategy of an average of 5% increase annually, not including those units that we're moving up to market. And then one that's more conservative where the rent growth is 3% than 5%. We think we're going to easily achieve more than a 5% annual rent growth on the stabilized units and those units that we're slowly bringing up to market based on historical trends within Long Beach. But again, we like to underwrite things a little bit more conservatively. So based on our more moderate rent growth projections and assumptions, we believe that over a 3-year time horizon, we'll be able to get investors to about an 18.6 IRR and about a 1.65 equity multiple. If we're not able to achieve that moderate rent growth strategy, then we think that we'll still be able to provide decent returns to our investors of about a 9% IRR and a 1.3 equity multiple. If we end up exiting at a 4.5 cap, and again, as we get closer to the end of year 3, we'll take a look at what makes sense, whether we should refinance and hold on for another couple of years, or whether we should try and sell the property based on the increased density and zoning of the underlying land, or whether we should exit at, say, a 4.5 cap. We still think that we're going to be able to provide investors a decent return of a 16% IRR and a 1.5 multiple. But again, also, if we're not able to achieve that moderate rent growth strategy, which we think we'll be able to do, then we're looking at potentially a 6% return over the 3 years. And what does this mean for you as an investor if you invest $100,000? Leveraging the example here in the upper left, where we're able to achieve the moderate rent growth strategy and exit at a 4.25% cap rate, then in year 1, your annual distributions will only be about $1,500. And partly that's due to the number of units that we're planning to turn in year 1 is 9 units. So we're going to have a little bit higher vacancy and lack of rents, and we're getting all those units up to market rents. And then in year 2, that'll almost double. And then in year 3, once the asset is fully turned and become a stabilized asset, we return any unpaid reserves and we sell the building, then that's when we'll be able to provide the return of equity and return on equity. Year 1 and year 2, also, since we're not achieving that 7% preferred return, that is going to accrue, that unpaid prep is going to accrue and carry over into future years, compounded at 7%. This slide discusses a little bit more in depth on our investment strategy, and also our PPM will go into more details regarding our investment strategy and business plan. As we stated at the beginning of the call, we seek to maximize risk-adjusted returns through applying value-add strategies and limit our downside exposure over the investment term. We formed an exceptional acquisition and management team, half of that which is right here with Anthony and Malcolm. Our property management team is Borba Property Group, which I'll talk to you more about them in follow-on slides. We underwrote the opportunity with realistic and defensible assumptions and believe the rent growth assumptions will be exceeded, and we have additional slides that share some more of this market information. We plan to take advantage of the large rental price disparity And over on the right, you'll see where the unit rents are in comparison to their market comps. We also have rental comps, which we can go through at the end of this presentation. We plan to initiate a rental increase strategy, maximizing annual rent growth, and vacate and renovate 9 units in year 1, partially due to those vacancies, and then the remaining units in the next 2 years. As soon as we close, we plan to begin immediately renovating those existing vacant units and have already started setting up our handyman and general contractors to get in there as soon as possible after. We're going to continue assessing multiple exit scenarios to maximize investor returns and then position the property to sell at an above market price. The information and CoStar table on the right demonstrates we're acquiring this building at a significant discount to both the submarket and Long Beach price per unit. Regarding debt, we have an LOI from a local market rents lender, 3 years fixed rate at 4.33% at a 65% loan to value. Once the appraisal comes in, they'll reevaluate and finish their underwriting, but we feel pretty confident that we're going to be able to move forward with a 65% loan to value loan. However, we've also underwritten the opportunity at 60% loan to value. Anthony and I are both personally guaranteeing the loan. It's fixed for 3 years. Debt service coverage ratio is 1.2. It amortizes over 30 years. The loan is not assumable, and the loan term is 18 years. This is a cash flow analysis and associated assumptions for a 3-year investment time horizon with a 65% loan to value debt. And this might be a little bit hard for you to read on your screen. I'm happy to set up future calls with any of you to go through the numbers in more detail and or send you the PowerPoint or the spreadsheets if you want to go through it in more detail. We're still digging out of our COVID-19 pandemic, unfortunately here, especially in Southern California. So we have incorporated a risk mitigation strategy of setting aside 2 full months of debt payments and expenses. We've also underwrote to keep a margin between current and market rents and partnered with a local high-touch property management company that continually stays in positive communication with the tenants and has done a fantastic job for the rest of our portfolio over the past couple of years. Our detailed conservative assumptions include an annual vacancy of 5% standard, plus a certain percent for those down units that we plan to bring up to market rents each year. We have an additional, so you'll see in year 1, it's 7.7%. In years 2 and 3, it's about 6.8, and that's the 5% in year 1, plus the anticipated downtime for those 9 units that we're turning. And then in years 2 and 3, it's a standard 5% plus the additional time for those 6 units each additional year. Our annual rent increases, I underwrote a 15% year 1 annual rent growth, and then 13% in year 2 and 11% in year 3. And the reason I did that is I had 2% standard rent growth in year 1. And normally it's 5%. I took that back a little bit because we don't know exactly how soon we're going to be able to move those existing leases up in an increase in rent. Plus, I wanted to add an additional buffer in there because we still are coming out of this COVID pandemic, but then also blended in the additional 9 units that we're going to be moving from their current rents up to market rents. In year 2, it's about a 13% annual rent increase over the year. And again, that's a 5% standard rent increase plus a blended rate for those 6 units, and then 11% for the last year. We have standard annual turnover costs of $250 a unit, annual R&M $500 per unit, annual replacement reserves of $500 per unit. Our property management expenses are about 5.5% of rents collected, and I've added an annual 3% escalator for expenses. Our working capital and reserves calculations include almost $345,000, and that's based on budgeted deferred maintenance, a budget also of approximately, I think, $8,000 for each studio and 1 bedroom to get them up to market rents, along with $10,000 for each of the 2 bedrooms to get them up to market rents. And then, as I've stated before, we have additional reserves set aside in case we need to dig into them for COVID-related issues or other things. And if we plan to exit at a 4.25 cap rate based on a year 4 NOI, we hopefully should be able to sell the building for almost $8.6 million. At this point, I'm going to turn it over to Anthony to talk a little bit more about the multifamily market, trends and comps.
Thank you, Ivan, very much. Great job. So this building is really attractive to us for a number of reasons. Ivan's gone over a little bit about the specific location. But as a daily participant here in our market, I thought I would talk a little bit just about trends in the multifamily market here, rent comps and sale comps as well. This building is located, as you saw, basically right in downtown Long Beach. So this is in the East Village Arts District. This is, in my opinion, maybe the best neighborhood in Long Beach to own in. There is so much activity, investment activity going on here. There's very large, Class A developments. The tallest building in Long Beach was just recently completed, only a few blocks away from this project. And so there's lots of buildings like that are coming in and providing a really high-end option for a professional demographic that wants to live in this great location right by the water. Long Beach is unique in being one of only 2, urban cores right on the water in all of Southern California, the other being San Diego. Now, it's still an extremely supply constrained market when it comes to rental housing, just real honestly, like everywhere is in Southern California right now. So that new supply is not really competition for us, but it's a really good thing in continuing to move the market in a upgraded direction. So when you look around at what we have, this building is really well positioned to charge a competitive market rent that's still significantly below some of these Class A buildings right down the street, but significantly above what we might see, 7 blocks north of here in some of the other parts of town. So if you look at our rent comps, studios are going for around $1,550, 1 bed $1,795, and 2 beds at $2,095. You can see where our average rents are falling in the property on actuals. A nice little detail here that I think de-risks the deal quite a bit is we've recently sold 2 other buildings from this same portfolio a block away from here, an 11-unit and a 14-unit property, which had almost identical finishes and configurations on the inside. And our leasing agent has already been achieving these rents on renovated units in those properties. So that's a long-winded way of saying, basically, we already know we can get these rents because we're doing it right down the block in other properties. So very little uncertainty as to our ability to get those rents. As far as the way this building stacks up in the income metrics versus the sale comps, the average GRM of the comps that we're considering to be the best here is in the mid-15s. We're at 14.2. So we're getting a very good deal on actual income in place. You'll notice that there's a bit of a discrepancy there in the cap rate, in that you would expect the cap rate to be higher than a 3.8 for that GRM. And that's really just because of the current situation with the building's income and expenses. So we've calculated our GRM on a number that we think we can get 30 days basically into our ownership. Current ownership is using one of the units in the building as a management office for their portfolio. There's some vacancies in place, and there's some expense reduction stuff that we can do as well. So that's why you would see that mismatch there in the cap rate. Our price per unit is very competitive at $258 a door right there on 3rd Street. It's a great deal. Price per square foot is right in line, and the rent per square foot is below what you would see in a lot of the comps. As far as the direction of things, vacancy is at a ridiculously low rate in Long Beach, really all over LA. In this type of property, it's down in the 2s. So you'll notice that we're underwriting to 5% vacancy on an ongoing basis. But there's so much demand for this stuff that we've had success renting units on our other project that we closed on last year before the work is even complete because there's so much demand for these units. So we expect that to basically be the situation moving forward because there's just not enough new supply hitting the market all over Southern California to have a meaningful effect on the vacancy rate here. And then our property management partner on this deal, Borber Property Group, has done a great job keeping their collections super high and healthy throughout COVID. They've been above 95% with a 99% average since December of 2021. So they've done a really great job bringing the rents in for us. And obviously we expect that to continue here. Go ahead to the next slide. You want to advance the slide? There we go. So a little bit about the East Village Arts District, if you haven't been there before. Very cool, trendy part of Long Beach. Really in the last 10 or 15 years, it's kind of exploded. And if you have a chance to go down there and visit the property or just go, walk around the area a little bit, I highly recommend it. Very kind of artsy community. So there's, live work studios and loft conversions and a lot of kind of artist galleries and things like that in the area. They do a little kind of art fair and gallery showing once a month out on the street, which is on the street right over from this building. There's all kinds of kind of cafes, restaurants, bars, that sort of thing. So it's really a hot part of town to be involved in. It's definitely an area where we can take advantage of changing demographics in downtown. Very well located, great public transit access, very walkable, bike friendly. There's bike lanes. You can walk over to the train station and get up to downtown LA. And looking at the metrics, I included the metrics on the comps earlier, but if you look at our statistics from Buckingham's market research from Q1 2022, first of all, it's a pretty difficult little corner to even find property in, but when you do, it tends to be very expensive. So the comps were going at almost 17 times gross, pretty low cap rate, good price per square foot, and $385,000 a door average price. This building's got smaller units than the average, so but still at $258 a door, we feel like we're getting a really competitive deal here. So I love owning buildings in this area. I have in the past. It's just a really popular kind of happening part of town, and it makes us feel really good about our ability to get top of the market rents and the amount of demand that there is here from renters. Go ahead. So here's the sales comps. These are probably the most appropriate comps to use here, although there wasn't anything exactly the same as this building. You can see how they stack up. We had an average cap rate of a 4.2. The GRM, though, quite a bit higher at 15.4. We're at a 14.2 GRM. You can see the price per door at about 283, whereas we're at 258. And then our price per square foot is kind of right within the average. You'll notice that our property is further south than a couple of these comps, so arguably in a better location. The one on Appleton is probably pretty comparable to us, although that's over in Alamitos Beach, so not in the downtown area, but very comparable in general. You'll notice that they're all right around the same size too. 12 to 15 unit buildings. This one's a little bit larger, and these are very recent sales. So we feel really good about the numbers here. Go ahead.
Thanks, Anthony. For those of you that are unfamiliar with the city of Long Beach, it is actually the second most populated city in LA County out of all the 88 cities. About 466,000 people. It did not suffer much exodus. You hear a large exodus about people leaving California. There really wasn't exodus of people leaving Long Beach. That's because it's such a great city to live in. It's the 42nd most populated city in the US and the 7th most populated city in California. One of the unique attributes of the city is that its downtown is located right on the middle of about 5.5 miles of beachfront. And there's so much open space, about 4.1 square miles, and over 100 parks, which also attracts a lot of people to come to live and work in Long Beach itself.
There's actually another interesting little point there about Long Beach versus the rest of LA. Long Beach has really attractive rental metrics when you compare an overall LA average. These unit sizes in general, if you were to look up, LA kind of average rents for studios, 1 beds and 2s would be probably about $400 to $500 per unit higher than what we have here, especially considering the location. So it's been my experience, and we believe that there's still a really attractive differential for renters that might want to stay in the LA area, still have good access to if they work up in Los Angeles or in Orange County, but live in a cool coastal area. It's still very affordable relative to what you might see up on the west side or closer to downtown or the South Bay or something like that. Sorry to interrupt, Ivan, go ahead.
No, thanks, Anthony. Long Beach's diversified economy supports a multitude of white and blue collar jobs across a number of employment sectors. With the Port of Long Beach Airport, the Convention Center, hospitals, academic institutions, aeronautical and defense tech firms, Long Beach is actually trying to rebrand itself as Space Beach, and other commercial businesses. Long Beach's economy continues to grow, and with a significant decrease with the COVID-19 pandemic, shipping and tourism sectors have come back really strong. You've probably a lot of press reports about how there's just a backup of shipping at the ports of LA and shipping containers and miles long of cargo ships out on the coast. Additionally, it's conveniently located on the border of both LA and Orange counties and has a large transportation infrastructure facilitating trade and jobs throughout both counties. And then we'll have more information in the PPM if you want to drive more into the economic data of Long Beach itself. At this point, I'll turn it back over to Anthony to talk a little bit about legislation.
Thanks, Evan. So you may or may not know, but the state of California is a rent-controlled state these days. We had an assembly bill called AB 1482 that passed the state legislature in 2019 and became law in 2020. And that's basically statewide rent control. So if you don't know what that means, it's got a couple components to it. It's got a just cause for eviction protections component that basically says, as a landlord, you can't just terminate a tenancy without a cause. You have to have a just cause. And there's a specific list of just causes, including things like not paying the rent, doing illegal things in your unit, or you do have the ability to do substantial renovations to your property, vacate tenancies, and things like that. And there's in combination with the just cause for eviction protections, you have an annual rent increase limit as well. Now, it's actually a pretty mild version of rent control compared to what you might find in other parts of the state or the country. The annual limits are 5% plus the change in regional CPI here for the Los Angeles, Anaheim region from BLS. And so that's with a maximum of 10%. So the way that would calculate out since the law passed is you'll notice 2019 to 2020, they apply this from April to April CPI numbers, which are released in May, and then effective August 1st. Our initial increase allowable was 5.7%. This was obviously before inflation became a thing. The pandemic broke out and we started pumping money into the economy, and it became 8.6% last year. And then the numbers were just released last month. And of course, CPI was at 8.3%. So that brings us all the way up to that maximum 10% increase, which is allowable for increases taking effect on August 1st of 2022. That's on a rolling 12 months. So you can take that increase, depending on the last time you took your increase, you can take that maximum number. So the nice thing about this is as long as inflation is going to be present in our economy, which seems like it will be for a while, we can get pretty healthy increases. So if you looked at our schedule of rental increases on this property, even if we don't get a lot of move-outs here, we're basically going to be able to capture almost all of those rents during that 3-year holding period, and pretty much all the way there within 4 years. Now, of course, with inflation continuing, market rents will probably increase during that time as well. But really the message here is that AB 1482 is really not that scary. I own a lot of properties in this area. We've been dealing with this. It's a very different animal than, say, LA City RSO. If any of you have owned or been involved with properties in the city of Los Angeles, that's a much stricter version of rent control. They've got a whole, rent control board in the HCIDLA, which is, an administrative body that deals with landlords, and there's a lot of red tape. It's very difficult. AB 1482 doesn't have any of that administration tied to it, and it's just the law in the state. So it's much easier to operate within these constraints when you're not dealing with separate local rent restrictions and rent controls. So really not a big deal. We also have the ability to do 11-month leases for new move-ins, and those just cause for eviction benefits don't vest until a tenant has lived in a unit for 12 months. So in the event that somebody slips through our screening standards and they're not working out in the building, we do have the ability to get them out. And then of course we mentioned that if we need to do substantial renovations, we are also able to do those sorts of evictions. Long Beach is currently working on a ordinance to tighten up some details on that. So those aren't allowed currently, but that ordinance should be out within the next few months. And so if we did need to use that, we could. We don't expect to need to go that route though on this building. It's kind of that Goldilocks deal of decent rents in place. We're getting a pretty good deal on actual income, but the upside is still there as well. So it's just the kind of mix we like to see. Go ahead, Ivan. So you may have heard about the morass of different rules and moratoria and COVID protections for tenants in Southern California. And of course, we're in LA County here in Long Beach, and we're in California, so we have to deal with all of that. We are sort of coming to the end of the COVID eviction moratoria in the area. The statewide moratorium expired recently, and so currently evictions are allowed for non-payment of rent if we do have issues. There is an LA County tenant protection plan that was recently passed by the LA County Board of Supervisors that you may have read about. The details of that are in front of you, and basically for our purposes, this is an incorporated city, so the rent increase freeze does not apply. But we will not be able to evict for non-payment of rent if a tenant self-certifies that they're experiencing COVID-19 financial hardship through the end of the year. So that sounds pretty scary. That being said, this has been the law of the land anyway until April for the last 3 years. We're used to operating in this environment. Our property management partner has done a great job on collections, and we don't expect that to be any different here moving forward towards the end of the year. A couple consolation prizes on that topic is a group of landlord bodies have filed a lawsuit against the county regarding that phase 2 eviction moratorium, pointing at the due process clause of the Constitution and allowing tenants to self-certify their hardship. Additionally, there have been rent relief funds available from the state, and so the county has asked the state to replenish our rent relief fund stock. The state currently is running almost $100 billion budget surplus. So we do expect those funds to be provided again, especially understanding that that eviction moratorium is there. Our property management company has a lot of experience applying for those funds on behalf of the tenants, and we've had great success at getting those funds in, even if there are some delays. However, of course, we've budgeted here for reserves necessary to manage around these issues with this property.
Thanks, Anthony. To share some more information on Allianz development, my firm focuses on 4 main pillars for acquiring value-add opportunities, repositioning them, and providing risk-adjusted returns. First and foremost, preserving investor capital. We take seriously our requirement of being fiduciarily responsible for your hard-earned investment dollars, and we do this with disciplined underwriting and taking a more conservative approach to future performance, which you've seen a sampling of as we presented some of the numbers and cash flow and assumptions on this current opportunity. We also rely on leveraging local market information on neighborhoods, rents, tenants, and identifying distressed and off-market buildings. And once acquired, we execute a very focused, proactive business plan to optimize the property operations, renovate units, increase rents, and implement ways to increase income. And last but not least, relationships matter to us immensely. We look to develop and maintain long-term relationships with our partners and investors. Anthony and I working together believe we have a great competitive advantage over other buyers and syndicators that are pursuing opportunities. We are firmly rooted in the South Bay and local market. We have formed a top-tier team with companies who focused on Long Beach and especially collectively for more than 100 years, and we'll talk a little bit more about both of them, some of those teaming partners in the next slides. Our in-depth market knowledge and through our long-standing relationships in the market, we're able to identify and leverage off-market and distressed opportunities. And our strong project management and execution skills and high-touch service allows us to quickly implement our business plan while keeping tenant relationships positive and our investors in the know. On the right, you'll see a snapshot of 2 recent acquisitions where we've applied our strategy plan and competitive advantage. For Bennett Avenue, we've owned that property for about 8 months. It's 100% occupied. All tenants are paid current, and we've already exceeded our year 1 business plan. We've increased property revenues by 13%, and we've had to do no evictions and no cash. Pine Avenue, we've owned that for almost 2 years. It's 100% occupied. All tenants are paid current, and we're exceeding our business plan. We've increased property revenue by 47%, which way exceeds any and all expectations I had when I was seeking initial investment equity a couple of years ago. We've had no evictions and only had 1 cash for keys when we initially closed on the property. And we've doubled our anticipated first quarter returns of this year, or distributions to our investors. We plan to execute a very similar business plan for Atrium Lofts. This slide covers a little bit more information about Anthony's and my background. Most of this we shared with you verbally. And some of the rest of our teaming partners, of course, Anthony Walker Buckingham Investments is our brokerage firm, great firm, highly recommend them. Property management, Michael Borba Property Group. We've shared a little bit of information about them. They manage all of Aliana Development's portfolio. Anthony Walker uses them on all of his personal portfolio, and they are highly recommended by Buckingham Investments to all of Buckingham's clients. Anthony Horrigan of Reliance Law Group is our legal and securities attorney. I've used him for all of my deals. Fantastic, great individual to work with. And James Bowen of Stonehand is our tax consulting, accounting, and compliance services partner. Again, I've worked with him for several years and has been really impressed. I've been really impressed with his level of service and knowledge. And the newest member of our team is our leasing consultant, Tony Whitlow. His company, Saving People on Time. He has been fantastic. He is able to find us tenants for properties that we still have, or units we still have under renovation, and get signed leases before the renovations are even complete, saving us weeks of time and increased income with the decreased vacancy in each of the units. At this point, I'll turn it over to Malcolm to talk about next steps. And I think I go ahead and stop sharing at this point, right, Malcolm?
You can leave it on this slide for just another minute, and we'll talk about everything on here. Yeah, so this opportunity, since it's going to be a 506B, it's going to be open to all accredited and sophisticated investors. And we prefer a minimum investment amount of $100,000 per, with a total equity raise of $2.5 million. Everything that you're going to need and all documents are going to be actually on our portal, on Investor Deal Room. And we're going to try to get all the subscription agreements and all documents, the PPM, OA, all on there as soon as possible. But for the meantime, you can log into the portal and at least get your soft commitment registered. And let me share screens now, so I can show you exactly what that will look like. So you're going to receive an email. We have your email from registering on this call here, and we'll send you a link with all the registration information. It'll bring you to this page. And once you've registered for your account, you will be dropped into this dashboard, and you should have one opportunity on here, and that will be the Atrium Lofts investment opportunity here. You're going to want to go ahead and click on that, and you can scroll down through here. It'll have all the project information on here. It'll have all the documents once those are all ready under the Documents tab. And for the meantime, on the top here, you can hit Enter Soft Commit and put in as much as you want for your soft commitment. That way we can start keeping track of things and keep track of how many investors we have interested in the deal. For everything, this is going to be a first come, first served basis based on executed subscription documents. So please make sure that if you are interested, you check the portal and make sure that if the documents are up there, you get them signed right away so we can go ahead and reserve your spot. I think that's it from me. I guess also all funds should be received by June 30th at the latest for this year.
And just another little detail there as far as talking about what we can accept in funds and stuff like that. We are able to accept self-directed retirement funds. So this can be a great vehicle for investing if you have IRA money or 401k money that you feel like is not working very hard for you. That can be a great way to invest in a deal like this that would otherwise be very difficult to place those funds into. If you don't already have one, you'll need a custodian to hold the IRA or the 401k funds. And if you need some recommendations on custodians that do that type of thing, we can provide those to you as well. But in the past, we have had people invest in some of our deals with self-directed IRA and self-directed solo 401k funds too. That could be a really nice option here.
So we'll move it over to questions now. If anyone's got any questions, please feel free to unmute. Let me change the settings here so everyone can unmute.
Or throw it into the chat is fine too if you're in a loud spot. And as I think we mentioned this, but there'll be a recording posted to the website from this webinar if you'd like to review or you came in late. And that will be accompanied with a copy of the PowerPoint deck in PDF, as well as the private placement memorandum, the subscription agreement, the investor questionnaire, all of the documents that you would expect to see from an offering such as this will be available there. The website's pretty slick. We've used it on our last deal, and much easier using a website for this type of stuff than trying to chase down the paperwork. It saves Malcolm a lot of time, and I think it's a nice platform for everybody to see what's going on. And we'll start taking questions now. Andrew, thanks for joining us. I do not believe there are any Section 8 tenants on the property right now. Is that correct, Ivan?
As far as I understand it, there is no Section 8 tenants.
No Section 8 right now. Give everybody a minute to think of questions, type them in. Feel free to unmute if you want, to raise your hand. We'll unmute you.
Well, while people are thinking about questions, I have a few more pictures of the property. So I'm going to go ahead and take back over the screen. So you can see that a lot of the units need work. Kitchen cabinets are old, bathrooms need to be replaced, tile flooring. There's a couple units that are under renovation as of last month that the owner was looking to fix up. Roof is in great condition. You can actually see the 4 atriums in the building allow for greater airflow and sunlight into a lot of the units in the property itself.
The building actually has a ton of character locked within a bit of a dated appearance right now. If you were to imagine the facade and the common areas nicely restored, it could be a really cool Art Deco building. And so it's the sort of the look of the building is really perfectly positioned, I think, for this market. It's a very popular style, and there's a lot we can do with a pretty small renovation budget to spruce up the look. I don't think we got into a lot of detail on what our plans are specifically for upgrades, but the building's actually in really good shape as far as CapEx goes. The roof is only a few years old. The plumbing's in good shape. The electrical is in pretty good shape. There's only one sub panel, I believe, that needs to be replaced. We plan on probably doing all of the windows and a paint job, some exterior lettering to brand the building a bit, exterior lighting, and sprucing up the common areas so that the tenants just feel nicer coming in. And there's just a lot of opportunity here. One nice thing about this property is all the units are definitely on the smaller side, which is pretty normal in this area. I was struck immediately about the size of the kitchens and the bathrooms. The kitchens and the bathrooms are both unusually large for units like this. And sort of the main living areas and the bedrooms they're smaller, but they are very functional, compact. And there are some of the units in the corners and in the front of the building are quite large and have really great layouts. So we feel really good about the possibility for the market rents here. And I see some questions here on the specifics of the units. Converting 1 and 2 units to Airbnb rentals to diversify the income stream. We could certainly look at that. This would be an area where that would make a lot of sense. It's right kind of in the mix in downtown. It's near other hotels. It's walking distance to the convention center. So that would be something we could experiment with if we wanted to. It would certainly work well here. The wall heaters, some of the wall heaters are located in the bedrooms on your question there, Dennis. So we would have to relocate some of those. You shouldn't have a gas wall heater in a bedroom for carbon monoxide reasons. We can turn those over to electric heaters in the living areas instead. But the wall heaters, for the most part, were in decent shape. And so if they're in the living rooms, we would leave those alone generally. But yeah, the great thing about this building is it's kind of your classic example of a great building that just needs a little bit of love, not a ton. It's got pretty good visibility. It's got great curb appeal. It's got good access. And we really think we can do a lot with it. There is on-site laundry as well, so we can make a little bit of income there. There's a few parking spaces in the back. And I think we're going to do really well with the rents here. And I mentioned this before, but I think it bears reiterating in that we've basically already worked on these exact unit layouts a block away, and we're getting these rents already. So as an investor myself, that makes me a lot more comfortable with our ability to perform on the projected rents, because that's honestly the biggest thing, right? That's what determines your value. The building's already separately metered for electrical and gas, so we don't have to worry about any of that. What else? I think that pretty much wraps up the CapEx plan.
Thank you.
What other questions do we have here? Withdrawing funds after your investment, Paul. Our plan would be to distribute all the principal and the returns when the building is sold in year 3, or we would do a significant return of principal if it makes more sense to do a refi after 3 years and then sell in 5. We've left it open-ended to be flexible based on market conditions at that time. But the numbers, if the market were a little worse than today, we would hit our target metrics by selling in 3 years, and the IRRs that we projected would be there at about an 18%. So a sale at year 3 right now looks like the most likely outcome, although we could end up in a 5-year hold. We are not currently thinking about exchanging out of this, but I suppose that would be a possibility at the time of exit if we had a lot of investors that didn't want a tax hit and they wanted to exchange into another opportunity. We could talk about it at that time with everyone, and we most certainly could look at exchange opportunities for the funds as well. We kind of glazed over this a little bit, but we are going to be doing a cost segregation study on this property too. So if you have tax benefits in mind, I know I do, the cost seg study is a great way to do that. If you haven't participated in an investment before where that's done, the idea is we hire a consultant engineer to separate the different depreciable elements of the property out into 5, 15, and 27.5-year buckets. And we're able to accelerate a lot of the book depreciation on the property into the first 5 years. Currently, there's bonus depreciation allowable for that 5-year bucket as well. So you would get a large write-off in year 1 in the year of acquisition on your K1. And that would flow through to everybody on a pro rata basis on the K1s that we deliver. So you do get some great tax benefits out of this property. Let's see what else we had. I think I covered the expected investment timeline, Andrew. Thank you for that. And for Hank, what's the estimated time to turn the units being remodeled, and have you factored in any cushion for possible delays or further cost increases in building materials? Ivan, you want to take that one? I know you're in the details on the renovations.
Sure, and unfortunately Hank had to drop off, but we'll provide an answer and hopefully you can catch it on the recording. So we're anticipating, or I've underwritten about a month to turn each unit, and that seems to be almost in line with what our handyman and GC has been able to do on our other units. It actually takes them about 2 to 3 weeks. Because we're doing a little bit more extensive here, we're planning for a month. And yes, we've incorporated additional cushion for possible delays or further cost of increase in building materials.
Thanks, Ivan. David, great question on the tax benefits. We do plan on closing the deal in early to mid-July. And so my understanding, and you should of course confirm any tax information I'm giving you with your appropriate tax professionals, but my understanding is that you can apply that bonus depreciation to your tax return on the year of purchase, the year the building was placed into service. So obviously we're collecting rents here, we'll get prorated rents in escrow, and we're closing in the middle of the year. So you'd be able to take that bonus depreciation in tax year 2022. My understanding is also, though, that if you maybe have a lower income year this year, but you're looking at a higher income year next year, you would probably be able to carry forward that loss if it exceeds your offset from any income that you'd be using it against. So the answer would be either, but check with your CPA.
Yeah, thanks. I sold my house in LA, so I'm looking for offsets.
There you go. Yeah, I need to buy buildings every year. I'm in big trouble. So yeah, this one helps for sure.
Cool, thanks.
Yep. Okay, it's 3:01. So if there are other questions, we can stay on and take those. Otherwise, stay tuned to your email for a recap and an invite to join the website that we have where you can pull down all the documentation. Of course, feel free to reach out to Ivan, myself, or Malcolm with any detailed level questions. We're happy to share our super granular underwriting. Ivan has done an incredible job on this. He's performing very well for everybody on the Bennett deal that we put together last year. I've been personally extremely impressed. And so I am more than happy to partner with Ivan again on this opportunity and personally guarantee the loan, just because he's taking that military mindset to managing these deals. He's doing an incredible job. He won't take credit for it himself, but he's really doing an amazing job.
Thanks, Anthony. We just got one other question from Dennis Wood, who's actually my father. Thanks, Dad, for joining today. So right next door, there's an alley that borders the left side of the property, and then a small apartment building to the left of that, and then a large church to the left of that. To the right of the building, it looks like it's a small garage. Don't quite know what goes on there.
That's actually a little creative, like live work studio that was just restored and sold for a pretty big number. It's like a owner occupied little like live work space.
All right, perfect.
And then there's a cat cafe to the right of that. So if you want to go pet some cats and visit the property, that's on you. Across the street, sorry to steal your thunder, is the Civic. I think it's called the Civic Motel, right? And that's all boarded up right now. We did a little bit of digging, and it looks like that was recently sold. So I think that's going to turn into a large development across the street, something new construction.
So we think all these properties are going to help appreciation of this property itself.
Okay, well, thank you everybody for joining us. We are past the hour mark. So again, hope to hear from you. Reach out to any of us with questions. You should hear from Malcolm with links to recap the webinar and look at all the more detailed docs. And we are looking forward to working together. Thanks for coming.
Thanks, everybody. Appreciate your time today. Have a great weekend and look forward to hearing from you.
See everybody later.